Welcome to the Financial Advisors Want to Know podcast, sponsored by Dominion Enterprise Services. I'm Catherine Tindall, CPA and founder of Dominion. We're a tax and accounting firm focused exclusively on serving advisors for their own tax planning and filing needs as business owners. At Dominion, we work alongside advisory firm owners to bring proactive strategy, clarity, and confidence to their tax planning so they can focus on growing their firms. The focus of this show is to cover different areas that I've experienced as a tax planner, working with advisor clients in their lives, building their practices. So let's get started. Well, I cannot believe that this is already the 100th episode of this podcast. As I reflect back on all of the different wonderful guests that we've had, the topics we've covered, the way that it's grown me as a professional, I'm really grateful for the opportunity to get to 100 episodes and all of the people that helped me get there, including my team and all the wonderful guests we had. So I wanted to do a special episode today for our 100th episode. And this is going to be, one of the questions sometimes people ask me is, why don't you really do much tax stuff on your podcast? And I think for me, a big reason why I don't usually have a big emphasis on the tax side of things is because it's hard to make it evergreen content because the tax laws are always changing. And then also, for the most part, it's such idiosyncratic advice when it comes to what's actually going to work for an advisor for tax strategy that oftentimes really learning all of this stuff or me presenting in so much technical detail, it can just create a lot of overwhelm rather than bringing a lot of clarity in my experience. But on today's episode, I'm going to be focusing on a presentation that I tend to give to other groups, or I modify this for different situations. And today's episode, we're going to be doing Maximize Your Value, the Accounting and Tax Foundation of Business and Succession Planning. So I'm going to be painting a very broad brush with a lot of different topics today. And the goal is really to take you through the progressions of areas where I see pitfalls working with firms and go through different opportunities and ways to kind of look at these things. For those of you who are listening in on an audio only format, we're going to have in the show notes nearby the video version of this because it does have an accompanying slide deck that has a lot of detail on it and that will help kind of bring cohesion to what's going on. But I'm going to try the best that I can to kind of speak generally with this stuff so that if you're on your way to the grocery store, wherever you are listening to this, at the gym or wherever it is, you'll still be able to follow along without the visual cues. So that's my goal for today. So this presentation, I'm going to be going through kind of 4 big buckets of the areas that I like to look at when I'm looking at a firm's planning. So I'm going to start off with step 1, which is essential accounting infrastructure. So I picked the sexiest thing first, right? Essential accounting infrastructure. Then we're going to go into the second step, which is once we've got that good infrastructure in place, now we can have fun doing tax planning. So we're going to talk about some common tax planning opportunities, which are things that you could be implementing today. And then we're going to move on to step 3 and step 4, which are both centered around succession planning. So we're going to start with succession planning for today. So what are the things you need to be doing right now to think about succession planning? And then step 4 is succession planning for the future. What do you need? If you're really in an active succession planning situation, what are some of the very high level things that I think you should be thinking about just based on, my experiences in casework with advisors doing this. So my goal for today is really to make this a red flags orientation. This isn't going to be me teaching you how to file an S-election. This is going to be, in my experience working with advisors as their advisor, the kinds of questions that they ask and giving you a primer on what are the things that you should just generally be aware of and how do these things work from, more layperson's perspective so that you can be a good conversation partner with a tax professional when it comes to these things. And the nice thing with this is I'm orienting this towards my experiences working with firm owners directly, but all of these things for the most part are also going to apply if you work with business owner clients. It will also help you understand better kind of some of the tactical and strategic things that go on in the high level tax planning for business owners. So I'm going to try to keep everything very action level. And I invite you, if you have questions or you want to do, you have specific things that stick out, please feel welcome to send me a DM on LinkedIn because I'm always trying to tailor this content to really drive towards what advisors in real life are asking me. So a little bit of my background, I'm just going to assume that this is not your 100th listen of the show. So my name's Catherine Tindall. I'm a CPA with Dominion Enterprise Services. We're a CPA firm that specifically niches in tax planning and income tax returns for financial advisory firms. So we work with people at broker-dealers, we work with RIAs, we work with 1099 advisors, IARs. The common niche for us is really just wealth management practices, their owners, and kind of integrating closely held planning for them. I've had over 16,000 people attend my continuing ed presentation, so I hope that means that I've gotten somewhat better at it over time. So that's my background. And then for this, because this is just a podcast, usually in these presentations, we do the, submit Q&A afterwards and I'll answer your questions. But just as a special offer as part of this podcast, if you have any questions off of this, feel welcome to reach out to me on LinkedIn, or we'll provide other contact info nearby. Feel welcome to ask questions, mention that you saw the podcast, etc. And then also for those of you who are interested in getting a copy of the slides, just contact us and I'm happy to send you over a copy of the slides related to this if you want to keep it. And that's that. All right, so step 3, we're going to start talking about succession planning. So we went through the really boring to the tax planning, which is like kind of fun. And then I feel like succession planning is something that people get, it's where I get a lot of questions and people are more excited about. So succession planning for today, these are things that I want you to be thinking about. First is getting your accounting system to work for you. So if you're working for your accounting system, if you don't have that good infrastructure in place from that first section, then I'd recommend, getting that stuff sorted. It's important, but not urgent. And so, trying to prioritize that. What does that actually mean for investment on your side is really just, if you need to outsource it, spend some time finding a good professional to outsource it to, because if you look at the value of your time, most of the time outsourcing is going to be less expensive and, less painful, obviously, if you find the right person. Second piece is getting your tax strategy proactive in your current state. So before you even start thinking about making sales or changes, like, are you operating in an S Corp efficiently? Should you even be an S Corp? Maybe you shouldn't. Are you paying yourself properly? Are you doing PTE? Are you, dealing with family strategies correctly? Are you making strategic reinvestments? Like, are you efficient currently? And then we can start to look into the future. And then, considering those investments back into the practice that increase your exit value. So what are those strategic deductions that are going to bring you future growth? And another piece is consider getting a valuation done. So you can see where your key weaknesses are. I know for a lot of firms that I work with, key man risk is huge. A lot of it just rides on the chief advisor. And if that person goes down, problems. So you want to look at how your current firm is set up. And especially if you're solo or don't have a lot of strong team underneath you, consider focusing some of your strategic reinvestments into de-risking that part of the business. And the other component I want you to think about is start to think about how you're going to plan to exit. So you can structure with that in mind. So if you're going to do an internal exit where you're going to sell to employees or family members who are in the business, that's going to look very different with how you reinvest back into the practice and how you try to grow it and even how you try to exit out of it versus if you just do a pure, I'm going to sell externally, I'm going to find another advisor who's a friend who's going to buy my book, or I'm going to go, to PE or a roll up or whatever it is. That's going to be a very different process as well. So you want to start to think about that because that will also tailor how you do the investments back into your practice and just, how aggressive you want to get, et cetera. And so my one piece of advice is even if you're not exiting, I talk to a lot of advisors who are like, I'm going to do this till the day I die. And that's a beautiful sentiment. That's not everybody. If you're not exiting right now, a business that is good to sell is a business that is good to own. You're constantly selling that business to yourself. And so the more you can professionalize it and the more you could make it attractive to an outside buyer means that it just genuinely is more attractive, right? And it's going to be more attractive to you as the primary investor in it. So always put that investor perspective on it for yourself, right? This business is an asset. And how do I make this business serve clients better? How do I make my revenue stickier? And how do I make it have less risk? Market risk, personnel risk. Is that me? Am I the personnel risk? Technology risk, legal risk. Big one is concentration risk. Like, do I have a couple of really big clients, and then a big population of really small clients where I have a lot of risk in a couple of key relationships? Well, then how can I work to de-risk the business? And then from the employee perspective, it's, how do I help engineer this business to produce the best return? How do I get this business to produce a good return given what we're, our strategy and our time horizon? So you're kind of wearing both hats at the same time. And so, I encourage you to think about what's the current bottleneck in the business that's holding it up from where it's going to go next. So you have a vision for where you're going to be driving your firm over the next 5 years. And maybe you're a lifestyle practice and you're happy. Great. Then you're good. You're there, right? But if you're not and you're trying to grow it, then we look at, okay, well, your business is here. So with the example, I'm a $1 million business. I want to be a $5 million business, or I'm a $500,000 business. I want to be a $2 million business, or wherever it is. You have a future state in mind, or I'm working 2,000 hours a year. I want to work 1,000 hours a year. That's a future state, right? What's the bottleneck holding you back? And then how do we reinvest to get there now? How do we speed it up, right? How do we get that outcome into the future, out of the future and into the now? How do we make these investments, right? Is it a knowledge gap? Is it a skills gap? Is it a person gap? What's the gap, right? Is it too many low value clients? Is it weak systems? Is it a client acquisition issue? Is it too much of your time? Your focus is, you don't have enough focus. What's the bottleneck? Why are you not at your future state? And so how are we using those profits to build the firm that you want and bring it into the present now? Because that's just going to be more tax efficient. It's also going to make your life better. It all hinges on de-risking the business. So you have to make good investments, and so you have to be careful, but you can do things like paying debt, professionalizing functions, de-risking delivery through systems, having enough support personnel. There's so many can do things, right? There's a million things we can do with our business. But I emphasize, if you're not sure what the investment is, focus on bottleneck. That word bottleneck is really important. You don't want to be building excess capacity farther down the production line, because you're still just going to be stuck wherever the bottleneck is, right? It's what is the core thing if we poured 10 times on this, that it would break everything? Well, then that's probably where our bottleneck is, right? Is it we're not getting in enough client referrals? Is it that, I'm having to do every meeting, as the main advisor, what is it? There's got to be, find the bottleneck. So that's succession planning for today. And then we're going to talk about succession planning for the future. Catherine here. Just wanted to say thanks for tuning into the show and hope you've been enjoying it. Since we're all at the mercy of social media algorithms, if you wouldn't mind rating the podcast on whatever platform that you listen to, I'd really appreciate it. And also, if you're looking to stay in the loop on current tax updates, what the firm is working on, and just the things that I think you as a firm owner need to be aware of when it comes to the world of tax, you can sign up for our newsletter using the link below. I only send out editions when we have really useful things to share or things that I think are important to have your attention and energy on. So let's get back to the show, and thanks again for being a listener. So these are for the people that are closer to exit. So, if you're, I'm actually ready to go out the door fairly soon. This is going to be more of that conversation. So I'm going to talk first about internal succession. And I'm going to talk about these at a really high level. If people are interested in this, I can obviously do some future episodes on it. Just let me know. But internal succession, consider complications if it's not a full 100% sale. So if you're going to be co-running this business together and you're going to sell in tranches, you're now going to be partners for a certain amount of time. And that just has a lot more complexity in it than just a pure 100% handoff. So just be careful with that. I would always recommend, and I'm not an attorney, but having been involved in these cases, consider doing a draft operating agreement before you do the actual sale agreement. And part of this is because you're not buying the business, really. You're buying this ongoing operating relationship is actually what you're signing up for. And so you want to make sure that the full components of what's going on with that are spelled out early. How are we each going to get compensated? How does that get calculated? How do we do distributions? How is the record keeping going to work? How are expenses going to work? What if we don't agree on an expense? What happens? What happens if one of us gets sick and dies? What if one of us gets divorced? What if one of us is disabled and can't work? Do I have the first right to buy out the rest of the business to you? How is that going to get valued? Who determines the value? There's so many, and that's just a small example, a handful of provisions. You really got to work through all of that stuff because, like I said, if you're doing a tranche sale and this is going to be the kind of main vehicle of your wealth building as an advisor, you just have to tread very carefully. Like I've seen a lot of these deals blow up when the operating agreement was like a kind of boilerplate canned thing. And then they actually get into trying to operate the business together, and they don't have alignment because maybe you've got one person where they're used to being, a solo owner, and now all of a sudden they're bringing somebody else in, and they have kind of, maybe some bad habits of being a solo owner and accountability that, need to change, or, vice versa. You have another advisor who's coming in as a partial owner who's not used to being a business owner. They're used to being an employee, and maybe they still really have an employee mindset around things. So you can have some disalignment there, and it's just important to be sensitive to that if you're not doing 100% sale. Other piece, really important before you do any of this, consider full modeling of impacts on the buy side. On the sell side, it's going to be it's mostly going to be capital gains. You might have some like ordinary income, but you're the one that's getting money, so it's usually easier to pay the taxes, right? For the buy side, they're the one that's paying money, and sometimes that paying the money can be coming through taxable profits, and they don't realize that $100,000 that they just paid you in principal payments is also going to have to get income tax paid on it. So consider having modeling done on the buy side for sure. Like both sides, I would, but especially on the buy side, and that there's some significant differences between stock acquisition and asset acquisition. So just do your homework on that. And then if you're the seller, consider, if you're doing seller financing, installment sale treatment, if you'd rather have more like kind of an annuity style thing where you get paid out over time, that's going to be, cleaner for you for a capital gains perspective. And the other piece with internal succession that's a common topic that I bring up is, just because you're selling the business, so you as the investor is selling the business, it doesn't mean that you as the employee have to leave the business. It doesn't necessitate that. So I have a lot of advisors where they're, I want to do this till the day that I die, but I don't want to wear the CEO hat anymore. I just want to serve the clients that I've been serving. I want to be golfing more. I want to be with my grandkids more, or whatever it is, right? You don't have to say goodbye to everything. You can really, when you're doing internal succession, if you're really clear on really what is the dream outcome you want, like you close your eyes and you visualize it, a lot of the time we can get there. And then we can try to reverse engineer what's going to be tax efficient for you as the seller, and then for the buyer as well, to really try to make that outcome as optimized as it can be, and how much flexibility you're going to need in operating structure. But anyway, external succession, this one's trickier because a lot of times if you're doing an external succession where it's like PE or a bigger company, you're just going to be playing by whatever their rules are. You're not going to have a lot of negotiating power. So a couple of things that I've just seen in these kinds of cases, just consider what your continued role in the practice is going to look like if you're going to be continuing to work in the firm. I've had a couple of advisors where they considered doing these kinds of deals, and then they looked at what was going to be expected of them and then clawback provisions that they were going to be subject to, even though they didn't have full control, and they ended up backing out. Consider tax impacts if you're going to have large capital gains up front, especially state capital gains rates, because sometimes you can get duped on those, if you're only thinking really about your federal, but then your state has a progressive capital gains rate. And then consider if accounting records, consider if accounting records have your ownership basis correct for capital gains calculations. That's quite the accounting mouthful, but basically ask your accountant, hey, is my basis records up to date? Like if I go to sell this, what's my capital gain going to be? And then if you're really targeting an external succession, so I've had some firms where they're like, we're going to run this for 5 years and then we're selling external. Great. Like no judgment on that. Just consider having a detailed valuation completed soon so that basically you can target the areas that you want to improve with the eye for an external sale, because basically when they go to value you, they're going to do a valuation, and, valuation methodologies can vary. But if you start from the perspective of, okay, I want to be out in 5 years, well, what's your to-do list for the next 5 years? What are the things you should really be optimizing for that exit value? So that's going to be things like reducing key man risk, revenue concentrations, other things like you might have IP that's actually more valuable than your book. So I had an advisor where they had a very specific niche of clientele that they service, like a very specific niche, and they were just very dominant with education and marketing to that very specific niche. It was very attractive to an outside buyer. They got a wonderful offer. And so for them, it was, the multiple was crazy because really the outside buyer saw the value in the IP. and the marketing positioning. So things for you to consider as well. If you've got something like that, like an ace up your sleeve with a kind of niche, maybe leaning into that. But having the valuation done can really help with the focus on that. Though I would say if you've got an IP thing where it's a marketing niche, evaluation actually might miss that. They might undervalue that versus things like, your kind of normal routine kind of stuff. At least what I've seen in valuations is, the way that they do them, unless they're a marketing professional or really understand how these businesses work, which not a lot of valuation is kind of a standardized thing, that might end up getting undervalued. But, a lot of people don't really lean into that. So, if you have that situation and you have a valuation, like send me a DM. I'm very interested in it. Anyway, so we hit all our main points today. I know this was a much longer episode than usual. Maybe my lovely editor will split us up into multiple episodes for the different steps. Will be 100 and plus episodes. But so for the main points today, just to summarize again, kind of where we were, where we ended up. We first started talking about that essential accounting infrastructure. So that's your record keeping function working well. That's your tax forecasting function working well. That's how you make your estimated payments as a routine thing. That's not stressing you out. That's not surprising you. And then the second step is deploying those common tax planning opportunities. So like we talked about, starting with the cashless things, your entity structure, the one pocket to another things like optimizing QPI, the PTE deductions, hiring family members, things like that. And then we look at the cash-based ones, retirement contributions, which, I don't have a dog in that fight. And then, really with the strategic reinvestments back into the practice, that's really where the meat is. And then from there, talking through the succession planning for today. So focusing on the things that are going to professionalize the business and make it a good business for you to own. And then succession planning for the future, just some of those nuances around when you're going to make these transitions. What are some things that I've seen people miss for emphasis, and things that maybe you should be thinking about, whether you're doing this, in the near future or, you never plan to exit, things that you should just at least be aware of when it comes to these things. So my goal was for you to be a confident conversation partner with a tax professional. I'm interested to hear from you. Did we get there? I'd love to, send me a message. Let me know what you thought. And then, do you feel like you have an overall framework to think about the accounting infrastructure, the basic tax planning strategy, and how these play into succession planning? Do you feel like we got there? And then, what now, for me from the podcast, I'm always appreciative of getting reviews on here or just getting your direct feedback. But for people who are more interested in learning more specifically about how we serve advisors, a couple things for you. So I've got a tax newsletter that it's the same one we send to our clients. I recommend you sign up for it. We send it out once a month. It's basically targeted on questions that I get from our clients or situations that went sideways from somebody who's new into the firm, of something their previous CPA did, or changes in tax law, just things like that we want it to be useful. So I recommend you sign up for that. And then for those of you that are more interested, more hand in hand working with us, we do a initial advisor tax assessment. For those that are interested, and you're welcome to reach out, through, there's so many ways to reach out to us, and we can get you connected with some resources to learn about more what's in that. It's one of those things where it's like, if you've not been to the dentist for a long time, they do the x-ray of your teeth. It's that kind of a process where we're just, I'm having to tell people how much tax money they've wasted, which is not great. Sometimes they haven't wasted too much, but then they're on the verge of wasting a lot. And I like those conversations a lot better because we're able to, kind of say, the Hail Mary, like save the football at the last moment. So those are that. So I want to thank you for hanging on for this long. I would love to hear your feedback if there was anything that was of particular interest that you'd like me to do a future special episode on, or, just any feedback of what you thought was insightful, because I'm always trying to make these more useful for you, you advisors. But thank you so much for joining me, and we'll see you next time. Thanks for listening to the Financial Advisors Want to Know podcast, again, sponsored by Dominion Enterprise Services. If you found this episode valuable, I would love to personally hear from you. Connect with me on LinkedIn and send me a message. I'm always interested in your feedback, future episode ideas, or questions you'd like to see covered in a future episode of the show. And be sure to subscribe to our monthly tax update newsletter, where we share timely tax insights and planning considerations specifically crafted for advisory firm owners and what we share to our own clients. We'll see you next time.